Most people think the difference between retail investors and the 1% is money. It isn't. In 2026, capital is widely accessible, apps are everywhere, and markets are more open than ever. Yet the wealth gap in investing hasn't narrowed, it has quietly widened. The real divide is tools, structure, and information advantage. While retail investors react to price movements, the 1% are already positioned before those movements even become visible. They don't predict markets in the emotional sense. They engineer exposure using systems built on data pipelines, execution infrastructure, and risk models most people never see. If you understand the tools the wealthy actually use, how they see data differently, execute trades differently, and manage risk differently, you stop thinking like a participant and start thinking like a system. And that shift changes everything about how you approach investing in modern markets. The gap between retail investors and the 1% in 2026 is no longer just about capital. It is about access to infrastructure, data, and execution systems. Most retail participants still rely on public apps, delayed signals, and emotional decision-making, while the wealthy operate through integrated financial stacks that combine private research, algorithmic execution, and institutional-grade risk controls. This divergence has created two completely different investing realities, operating in the same markets. For the average investor, the journey begins and ends with visible information. They open trading apps, watch social media commentary, and react to price movements after they occur. Their tools are designed for simplicity, not dominance. Meanwhile, the top 1% are not reacting to markets. They are shaping exposure to them. They use direct market access platforms, prime brokerage services, and dark pool routing systems that reduce slippage and improve execution quality. A major difference lies in data ingestion. Retail investors consume lagging indicators, such as news headlines or chart patterns, while institutional players rely on predictive analytics fed by alternative data sources. These include satellite imagery of supply chains, credit card spending aggregates, shipping container tracking, and real-time sentiment engines that process millions of microsignals per second. By the time retail investors see a trend, institutions have already priced it in and rotated capital accordingly. Another overlooked tool is leverage efficiency. The wealthy do not simply borrow money. They structure leverage through derivatives, margin optimization, and cross-asset hedging strategies that minimize downside exposure. This allows them to maintain asymmetric risk profiles, where potential losses are capped while upside exposure remains uncapped. Retail investors rarely access these structures, which forces them into linear risk-reward models that limit long-term compounding. The gap between retail investors and the 1% in 2026 is no longer just about capital. It is about access to infrastructure, data, and execution systems. Most retail participants still rely on public apps, delayed signals, and emotional decision-making, while the wealthy operate through integrated financial stacks that combine private research, algorithmic execution, and institutional-grade risk controls. This divergence has created two completely different investing realities, operating in the same markets. For the average investor, the journey begins and ends with visible information. They open trading apps, watch social media commentary, and react to price movements after they occur. Their tools are designed for simplicity, not dominance. Meanwhile, the top 1% are not reacting to markets. They are shaping exposure to them. They use direct market access platforms, prime brokerage services, and dark pool routing systems that reduce slippage and improve execution quality. A major difference lies in data ingestion. Retail investors consume lagging indicators, such as news headlines or chart patterns, while institutional players rely on predictive analytics fed by alternative data sources. These include satellite imagery of supply chains, credit card spending aggregates, shipping container tracking, and real-time sentiment engines that process millions of microsignals per second. By the time retail investors see a trend, institutions have already priced it in and rotated capital accordingly. Another overlooked tool is leverage efficiency. The wealthy do not simply borrow money. They structure leverage through derivatives, margin optimization, and cross-asset hedging strategies that minimize downside exposure. This allows them to maintain asymmetric risk profiles, where potential losses are capped while upside exposure remains uncapped. Retail investors rarely access these structures, which forces them into linear risk-reward models that limit long-term compounding. Execution speed also plays a critical role. High-net-worth participants use co-located servers and algorithmic trading systems that reduce latency to microseconds. This means they can enter or exit positions before retail orders are even processed by exchanges. Over time, this speed advantage compounds into significantly better entry and exit prices, effectively transferring wealth from slower participants to faster ones. The psychological layer cannot be ignored. Retail investors often anchor decisions on fear and greed cycles, amplified by social media narratives. In contrast, the 1% operate under systematic allocation rules that remove emotion from decision-making. Their strategies are predefined, stress-tested, and executed automatically under predetermined conditions, reducing behavioral error rates dramatically. Understanding this divide is the first step toward closing it. The goal is not to mimic wealth, but to understand the architecture behind it so that informed adaptation becomes possible rather than reactive participation. Closing this gap requires awareness, discipline, and gradual adoption of professional-grade thinking, even without institutional capital. The shift begins with understanding structure, then building systems that prioritize probability, data quality, and risk management over speculation or emotional reaction to market noise. Over time, this mindset compounds into measurable performance differences across cycles and long-term wealth accumulation. One of the most decisive advantages the 1% hold in 2026 is their access to institutional-grade research ecosystems. Unlike retail investors who depend on fragmented information sources, wealthy investors subscribe to integrated intelligence networks that aggregate macroeconomic data, corporate filings, private equity reports, and proprietary analyst models into unified dashboards. These systems do not simply display data, they interpret it. Machine learning layers identify correlations across asset classes, detecting shifts in liquidity, inflation expectations, and sector rotation before they become visible in public markets. This allows elite investors to position capital ahead of structural changes, rather than reacting after volatility emerges. Another core tool is the use of alternative investment vehicles. While retail participants typically buy stocks or ETFs directly, high-net-worth individuals allocate through private equity funds, venture capital syndicates, hedge fund structures, and structured notes. These vehicles provide exposure to asymmetric opportunities that are not available on public exchanges, including early-stage innovation and distressed asset acquisitions. Tax efficiency engineering is also central to their strategy. Wealthy investors use jurisdictional arbitrage, trust structures, and tax-deferred instruments to minimize friction on returns. This is not about tax evasion, but strategic optimization within legal frameworks that preserve capital and enhance compounding efficiency over decades. Risk modeling systems further distinguish their approach. Instead of relying on simple diversification rules, institutional frameworks simulate thousands of market scenarios using Monte Carlo analysis and stress testing models. These systems evaluate portfolio behavior under extreme conditions, such as liquidity shocks, currency crises, and geopolitical disruptions. Retail investors rarely access such tools, which leads to overexposure in correlated assets and hidden systemic risks. The 1%, however, construct portfolios that are dynamically rebalanced based on volatility regimes and macroeconomic cycles, ensuring resilience across different market environments. Information asymmetry is not accidental, it is structural. The tools used by elite investors are expensive, complex, and often restricted to accredited participants.
However, understanding their existence is the first step toward narrowing the gap between retail participation and institutional strategy. Some retail investors are beginning to bridge this gap through emerging fintech platforms, open-source financial data APIs, and commission-free brokerage tools that now offer partial access to advanced analytics previously reserved for institutions. However, access alone is not sufficient without the interpretive frameworks that professionals use to contextualize signals with broader macro cycles. The real advantage lies in combining data with disciplined strategy design, where position sizing, entry timing, and risk exposure are mathematically defined rather than emotionally chosen. Over time, those who adopt institutional thinking patterns can partially replicate aspects of elite performance, though structural limitations will still persist in areas such as liquidity access and private deal flow. Even so, the widening availability of data tools suggests that the future gap may be less about information access and more about behavioral discipline, analytical rigor, and the ability to execute consistently under uncertainty across multiple market regimes, without deviation from predefined strategic rules over extended periods of capital deployment cycles.
The trading infrastructure used by the 1% in 2026 extends far beyond conventional brokerage platforms. At the core of their execution systems are prime brokers and multi-asset execution venues that consolidate trading across equities, derivatives, fixed income, and digital assets into unified liquidity pools. This consolidation reduces friction and allows for precise capital allocation across global markets in real time. One of the most powerful tools in this ecosystem is algorithmic execution. Institutional algorithms break large orders into microtransactions that are distributed across multiple venues to minimize market impact. These systems use adaptive logic that responds to liquidity conditions, volatility spikes, and order book depth changes within milliseconds. Retail investors, by contrast, typically execute orders manually, exposing themselves to slippage and unfavorable pricing. Another critical advantage is access to dark liquidity pools. These private trading venues allow large participants to execute trades without revealing intent to the public order book. This prevents price distortion and reduces front-running risk. While retail traders operate in fully transparent environments, institutional players often transact in partially hidden liquidity channels that optimize execution outcomes.
Data infrastructure also plays a central role. Elite investors operate on high-frequency data feeds that deliver tick-level market updates, macroeconomic indicators, and sentiment analysis in real time. These feeds are processed through quantitative models that continuously adjust portfolio exposure based on changing market conditions. Risk control systems are embedded directly into execution engines. Rather than treating risk as a separate function, institutions integrate real-time risk constraints into trading algorithms. This ensures that no position exceeds predefined volatility or drawdown thresholds, even during periods of extreme market stress. The combination of speed, data integration, and structural access creates a compounding advantage that is difficult for retail participants to replicate. It is not merely about intelligence, but about architecture. The system itself is designed to outperform individual decision-making. Understanding this architecture reveals why performance gaps persist even when retail investors have access to similar information. Execution quality, not just knowledge, defines long-term outcomes in modern markets. Some modern retail platforms are attempting to close parts of this execution gap by offering smart order routing, fractional share execution, and automated dollar-cost averaging strategies that reduce timing risk. However, these tools still operate within public market constraints and cannot replicate the hidden liquidity advantages or latency efficiencies available to institutional participants who operate closer to exchange infrastructure. The implication is that execution advantage will remain a defining feature of market stratification, even as information becomes increasingly democratized. Retail investors can improve outcomes by focusing on execution discipline, such as using limit orders, avoiding high volatility entry points, and reducing overtrading behavior that amplifies transaction costs. Additionally, adopting systematic investment plans and algorithmic tools can partially reduce behavioral inefficiencies. Yet the structural edge of institutional systems will persist because they are embedded directly into the market microstructure itself, making them inherently more efficient in capital deployment across time and volatility regimes and liquidity access. Portfolio construction is one of the most advanced areas where the 1% maintains structural dominance over retail investors. Rather than relying on simple asset allocation rules, elite investors use dynamic portfolio engineering that adjusts exposure based on macroeconomic regimes, volatility regimes, and correlation shifts across asset classes. At the foundation of this approach is factor investing. Institutional portfolios are often decomposed into underlying risk factors, such as value, momentum, quality, size, and volatility. By isolating these factors, investors can target specific sources of return while controlling unintended risk exposures. Retail investors, by contrast, typically invest in blended instruments without understanding the factor composition beneath them. Another key tool is scenario-based allocation. Instead of assuming static market conditions, institutions simulate multiple macroeconomic futures, including inflation spikes, interest rate shocks, recessionary environments, and geopolitical disruptions. Portfolio weights are then optimized to perform across a range of possible outcomes, rather than a single expected scenario. Correlation management is also critical. The 1% actively monitor how asset relationships change over time, especially during market stress, when correlations tend to converge. This allows them to reduce hidden concentration risk that often emerges in retail portfolios that appear diversified on the surface, but are actually exposed to the same systemic drivers. Derivatives are widely used, not for speculation, but for precision hedging. Options, futures, and swaps allow institutional investors to fine-tune exposure, protect downside risk, and enhance yield through structured strategies. These instruments function as adjustment tools rather than standalone bets. Technology plays a central role in portfolio optimization. Advanced systems use optimization algorithms that continuously rebalance portfolios based on updated inputs from macro data, price action, and risk metrics. This creates a feedback loop where portfolios evolve in response to changing market environments. The result is a level of adaptability that static retail portfolios cannot match. While retail investors often maintain fixed allocations for extended periods, institutional portfolios are fluid, data-driven, and continuously recalibrated for efficiency and resilience. Retail investors are beginning to adopt simplified versions of these approaches through robo-advisory platforms that offer automated rebalancing and risk-adjusted portfolio models. However, these systems typically rely on standardized assumptions and lack the adaptive sensitivity of institutional frameworks that incorporate real-time macroeconomic signals and alternative data inputs. The key differentiator remains the ability to integrate multiple layers of information into a single coherent allocation framework. Institutional investors combine quantitative signals, discretionary judgment, and structural market knowledge to construct portfolios that are not only diversified, but strategically aligned with long-term economic cycles. This integration allows them to adjust exposure proactively rather than reactively. For retail investors, the most practical improvement comes from adopting rules-based investing, consistent rebalancing schedules, and disciplined risk limits that reduce emotional interference. Even partial adoption of these principles can significantly improve long-term outcomes, especially when combined with continuous learning and systematic evaluation of performance across different market environments, and maintaining strict adherence to predefined investment discipline over time without deviation consistently. One of the most underappreciated dimensions of investing advantage in 2026 is behavioral infrastructure. While retail investors often focus on tools and platforms, the 1% invest heavily in systems that regulate decision-making itself. These systems are designed to remove emotion, enforce discipline, and ensure consistency across market cycles. At the institutional level, behavioral control is embedded into process design. Investment committees, risk officers, and quantitative oversight teams act as checks and balances that prevent impulsive capital allocation. Every major decision is reviewed against predefined models and stress-tested scenarios before execution is approved. Retail investors, in contrast, are largely self-directed. This creates significant vulnerability to cognitive biases such as loss aversion, recency bias, overconfidence, and herd behavior. These biases lead to inconsistent decision-making, which reduces long-term compounding efficiency, even when asset selection is reasonable. Another important tool is automated rebalancing. Wealthy investors use systems that periodically adjust portfolio weights without emotional interference. This ensures that gains are locked in and risk exposure remains aligned with strategic targets. Retail investors often fail to rebalance, leading to unintended concentration risk or drift away from original investment objectives. Performance attribution systems also play a key role. Institutional investors analyze returns not just in aggregate, but by decomposing performance into specific drivers, such as allocation effects, selection effects, and timing effects. This granular analysis allows continuous refinement of strategy and identification of weaknesses. Education infrastructure is another hidden advantage. The 1% have access to ongoing training programs, internal research briefings, and expert networks that continuously update their understanding of markets. This creates a feedback loop of constant improvement that is absent in most retail environments.
Ultimately, behavioral infrastructure determines how effectively all other tools are used. Without it, even advanced systems can be undermined by inconsistent execution and emotional decision-making. Some retail investors attempt to replicate this discipline through rule-based investing apps and automated portfolio managers that enforce periodic actions. These tools can help reduce emotional interference, but they still lack the organizational depth and multi-layer oversight found in institutional investment environments, where decisions are filtered through multiple levels of accountability. The most effective improvement for retail participants is the creation of personal investment rules that define entry conditions, exit conditions, and maximum risk exposure per trade or allocation. By codifying behavior in advance, investors reduce the likelihood of impulsive decisions during periods of volatility or market stress. Additionally, maintaining a structured review process, such as monthly or quarterly performance analysis, can help identify behavioral weaknesses and improve consistency over time. While retail investors may never fully replicate the institutional environment, they can still significantly enhance outcomes by introducing elements of structure, accountability, and systematic evaluation into their investment approach. Over time, these behavioral adjustments can compound an impact, leading to more stable returns and reduced drawdown severity across multiple market cycles, especially when combined with consistent learning and disciplined capital allocation frameworks over extended periods of market participation and economic uncertainty cycles. The future of investing in 2026 is defined by increasing technological convergence between retail and institutional ecosystems, but the gap in capability remains significant. Artificial intelligence, decentralized finance infrastructure, and real-time global data networks are reshaping how capital is deployed, analyzed, and optimized. For the 1%, these technologies are not disruptive, they are integrated. AI-driven decision systems assist portfolio managers by generating predictive insights, optimizing trade execution, and identifying emerging macro trends before they become visible to the broader market. These systems function as extensions of human decision-making, rather than replacements. Retail investors are beginning to gain access to similar technologies through consumer-facing platforms that offer robo-advisory services, AI-based analytics, and automated portfolio construction. However, these tools often operate in simplified environments that abstract away much of the complexity required for institutional-grade decision-making. Another emerging trend is the rise of tokenized assets and decentralized financial instruments. While these innovations promise greater access and transparency, they also introduce new layers of complexity and risk that require advanced understanding of smart contract systems, liquidity mechanics, and protocol governance structures. Despite technological democratization, structural advantages remain concentrated among those with capital scale, information infrastructure, and execution networks. The 1% continue to benefit from private deal flow, preferential access to liquidity, and integrated financial ecosystems that are difficult to replicate at the retail level. Ultimately, the evolution of investing tools does not eliminate the gap between retail and elite investors. It reshapes it. The defining factor is no longer access to tools alone, but the sophistication with which those tools are integrated into coherent, disciplined, and adaptive investment systems. Retail adoption of these systems is accelerating through mobile trading applications, AI-powered research assistants, and integrated financial dashboards that consolidate multi-asset exposure in a single interface.
However, these innovations often prioritize usability over depth, meaning that critical institutional features such as advanced risk layering, cross-asset correlation modeling, and liquidity optimization are either simplified or omitted entirely. The long-term trajectory suggests a hybrid future where retail investors will increasingly operate with access to institutional-grade tools, but outcomes will still depend heavily on behavioral discipline, capital scale, and execution sophistication. Those who learn to integrate technology with structured decision frameworks will be better positioned to navigate complex and volatile markets. In contrast, those who rely solely on surface-level tools without understanding underlying mechanics will continue to experience inconsistent results. Education, system design, and continuous adaptation will become the most important differentiators in this evolving landscape. As markets become faster and more data-driven, the ability to interpret signals correctly and act decisively under uncertainty will define performance more than access alone. The gap may narrow in visibility, but it will persist in practice due to differences in how effectively tools are applied across different investor classes, especially as global markets continue to integrate and financial innovation accelerates across multiple asset classes and jurisdictions in increasingly competitive environments worldwide. Markets.
The gap between retail and the 1% is not permanent, but it is structural. It exists because of differences in tools, but more importantly, differences in how those tools are used inside disciplined systems. You don't need institutional capital to improve your position in the market, but you do need institutional thinking, structured decisions, defined risk, consistent execution, and an understanding that markets reward systems more than opinions. In 2026, information alone is no longer an edge. Execution quality, behavioral control, and strategy design matter far more than access to headlines or trending narratives. The investors who win long-term are not the ones who know the most. They are the ones who operate with the most consistency under uncertainty. The real question is not whether you can access the same tools as the 1%, but whether you can build the discipline to use even simple tools the way professionals use advanced ones.